Hi, everybody. Barry McGuire here. It's Monday, June the 21st. It's time for the Monday main event in Barry McGuire's Creative Real Estate Education Group. And today we are delighted to have with us Dale Koeller from Calvert Mortgage. There's a longer name than that, and I should know what that whole name is. Calvert Mortgage Investment, and another word, corporation. Oh, I'm embarrassed. But when Dale comes on, he will tell us. So without any further ado, let's...
He just got disconnected, so you have a minute.
My producer, Donna, tells me that Dale just got disconnected, so he'll get reconnected and he will come back. Last week, we chatted about Securities Act things and attracting joint venture money and how you might do that, and what was allowed and what wasn't allowed by various securities commissions across the country. And in that discussion, we talked about exemptions to the requirement for a prospectus. A prospectus is a huge, long, complicated document that that if you want to sell things to the public, if you want investment money from the public, the basic thing that you do is go through a prospectus with the Securities Commission in your province. There's Dale. You're back, Dale. You're looking good. He's here. And so Dale's company, Dale's MIC, Calvert. Give me the exact proper name of your MIC, Dale. Oh, now you're muted. What's going on here? Producer Donna. Now we're checking. Well, we sort out getting Dale's volume back. And I know he has volume because in the pre-show when we were discussing things, he had lots of volume. So anyway, we'll sort that out momentarily. But Dale's corporation, which lends money. Sounds like you're here now, Dale. Let's hear some words.
Excellent. Sorry about that.
Yeah, well, hey, technology, man. What can you say? Technology. So give me the full name of Calvert.
Yeah, Calvert Home Mortgage Investment Corporation.
Calvert Home Mortgage Investment Corporation. CMHC, right? Oh, no, not quite CMHC, but pretty close.
Yeah, that was the trick my dad used when he started Calvert. He said, let's find a name that's close to CMHC. So our original initials were CHMC.
Right.
Calvert Home Mortgage Corporation.
Right.
It was our first company before we became a MIC.
Right. Okay. Well, let's that's a great way to tell people that Dale's been around this business for a while. He just didn't, start 2 years ago. His dad. So tell us about your dad a little bit and your family and how you got started in this business as we lead into exactly what is a mortgage investment corporation and how Calvert fits in the range of what those corporations can be. I want to hear about the family.
Oh, great. Well, I always love to talk about family.
Yeah.
My dad started in the finance business way back, maybe 50 or some years ago. And a guy noticed his talent and said, "Jay, we should start a mortgage company together. We should start a mortgage brokerage," is what he started in 1975. And that's when the Calvert Home Mortgage Corporation was started. And he brokered mortgages for quite a few years. But a lot of brokers back then couldn't even take mortgages to the bank. The bank they like to originate mortgages themselves. And so brokers weren't a very popular way of getting financing back then.
Yeah.
And so he would arrange mortgages with private individuals and place mortgages with private individuals who privately invested in mortgages. And that filled his bucket for quite a few years. He enjoyed that, but slowly and surely he built a little fund that people would invest directly in order to get a return on their money, and owned a little pool of mortgages. And the pool was nice because it diversified some risk. You didn't just own one mortgage that might go bad. You owned maybe a littler piece of but 10, and maybe if only one goes has trouble, then you don't lose as much money, or you make more on an aggregate. So so he started formally the MIC, the Mortgage Investment Corporation, in about 1982, and ran it for quite a few years for just himself. He lived through some tough 1980s here in Alberta, where things got pretty rough, but he weathered the storm and got through it. And my brother joined the company in about I want to say maybe 1996 or so, and I joined in 2001. My brother and my father, and it was 4 of us for quite a while, but we're much more than family now. We're 20. I think we just hired our 29th employee here, so we're quite a bit further away than just the 3 guys running a mortgage investment corporation out of their kitchen table.
Well, that is good progress. That is good progress. So, I mean, it started out with, as you said, putting a loan here, putting a loan there. I mean, starting the actual mortgage investment corporation, gathering in some funds, and there wasn't very much then, because you have to start out small when you're doing that. I mean, most people have to start out small. But what's the size of your fund now? How much money do you have under investment, under advice, under
right now we have $174 million in mortgages that we have invested. And we've had a really phenomenal year of growth actually this year.
Yeah.
So we've had a lot of that, we've probably doubled in the last couple of years alone. So that's been phenomenal lately.
And are you like everyone else connected with real estate, just going full out, as busy as you can possibly be, because that's what Calvert does, is it lends to lots of investors, but it's real estate related. I mean, are you just like everybody else on the busyness side?
We are pretty busy. We've where our success and busyness has come from lately is we've moved into the Ontario market. That's quite new for us. And so we're now servicing in Ontario as well as Alberta. Really, we've only started lending in in Ontario about a full calendar year. So 45 years of our history just in Alberta, which we've really loved, but it's really exciting to learn something new about a different economic market and real estate market and serve other people out there. So it's really, you learn a lot from your clients. So we really enjoyed learning more about the real estate market out there lately.
Okay. You mentioned your dad maybe was starting in the finance business in 75 and the MIC in 1982. Well, in 1982, as you were saying, tough times, the National Energy Program. I was working in Calgary at the time, and my goodness, a segment of the market that got hit really badly was the Mortgage Investment Corporation market. When I came back to Edmonton right around that time, I know there were some very active MICs, which is the abbreviation for Mortgage Investment Corporation, up in Edmonton that actually went out of business. They went out of business. I think they were a bit too adventurous in their lending, I think.
You forgot to mention about the giveaway. People have to comment.
Donna has reminded me of something that I will, as soon as I finish this comment, say. Darn. And so if your dad was starting to lend as a MIC in those days, it must have given him pause, because those were tough economic times. And I recall the chart after the National Energy Program came in, and the dropping price of houses, and of course, as house prices drop, lenders' equity erodes, or lenders' position erodes. It was 7 years before the drop came back to where it was in 1982. I'm just wondering when your dad was just getting going then, he must have been fully aware of that. And I wonder if your business runs the way it runs because he went, I'm never going to let this happen to Calvert. Do you have any sense of that, or any sense of that history at all?
Oh, yes. We talk about those sorts of things a lot, actually. they were really tough times in the 80s, and he had to take back a number of properties that people just could not afford with climbing interest rates, and so they would just hand him the keys sometimes, even, which is very rare right now. It doesn't happen often, but he managed to manage a rental portfolio of properties for quite a few years while he was getting back on his feet. And being self-employed, he actually took on other projects and worked outside of the mortgage industry for a period of time in order to make ends meet and make things work. But absolutely, you'll learn a lot about lending when you have to do the full cycle of lending, and it affects the way that you lend money in the future. So, and that's not a bad, actually. I wouldn't mind going back a little bit even further than 1980, because I think that how MIC started is, I think, an interesting story, because it's an animal of the government. The government decided that we didn't, as a country, have enough investment in home mortgages, and so they were really trying to encourage investors to put their capital up and give it to the common people. And back then we didn't have the National Housing Act, I don't believe, if I understand it correctly, the history. And so CMHC wasn't a thing, and the government really wanted money to get into this market. Now of course we have insured mortgages, but we didn't back then, and so it's maybe less needed than it was originally. But as a result, when MICs were started, we weren't really designed to have any oversight by government, which was great, and we still enjoy quite a bit of that lack of oversight in many ways. We MICs do have oversight in regulations from certain entities, but none of them really regulate how we lend. It's really the investor. The investor's money is buyer beware. The investor's money is put it where you think it's wise, but it's your money to risk. And so you mentioned some MICs going out of business. If you design some bad lending practices, or really just end up with some bad luck, which also happens, you can lose your money. So it needs to be invested wisely. The banks, by contrast, have a lot of regulation. The Office of Superintendent of Financial Institutions, OSFI, you hear in the news once in a while when mortgage rules change. They're fully designed to make sure that banks don't go under, because they're a huge basis of our economic fabric across the country. But one little MIC going under won't affect the market in a large way. And so we're left a little bit to our own devices, so to speak, from that point of view, because we can risk our money and it won't really affect the Canadian fabric of the banking institution, for instance.
Yes, that's a side of being a MIC or participating in a MIC that people need to know. Is it really is buyer beware. You need to know which MIC you are investing in, and you need to know who they are. MICs do go out of business every once in a while if they're not careful lenders, if they make mistakes, or if they have some bad luck. They go out of business, and really that is the risk that you take as an investor. You get paid a better rate of interest investing in a MIC than you would investing in less risky investments. And if you buy Royal Bank stock, you can get a dividend on that, but you don't get paid near as much as you get paid if they invest in your MIC. So we're not here to sell Calvert and tell people how fabulously well they can do by investing in Calvert. But if anybody is interested in a more passive investment, and you are an accredited investor, so you can look up on the Securities Commission what that means if you don't exactly know. An accredited investor is someone who has more resources, more net worth, and the Securities Commission believes that if you're that person, you are a little more knowledgeable about how you invest, and they don't need to hold your hand so much. So now, Dale, have you chosen as a policy to only deal with accredited investors as opposed to not doing that?
Yeah, and every MIC can make that choice directly, actually. So the route that we've chosen is to only raise money through accredited investors, people who are sophisticated investors. Some other MICs choose to put out an offering memorandum so that they can, through doing that, open themselves up to a bigger pool of investors. You don't need to be accredited that way.
Yeah.
That there's quite a big cost in order for a MIC to produce that kind of document. So we've chosen not to, but it's a very legitimate way of raising money in the private equity market. And still other MICs have gone public. So there's quite a few publicly traded MICs on the stock exchange that you could find as well.
Yes, those are ones like Antrim, I think, is one. There's a couple more. So there's quite a number, folks. There's quite a number of varieties of MIC, and I'm guessing that they also have different policies about who they lend to. Who are they looking to attract as borrowers from their MIC, and what are kind of the categories that different MICs would aim at as their investing public, shall we say?
Almost the sky is the limit, because there's what's exciting about the MIC space is that because they're not regulated, you can really design a niche MIC to what the investors really want to lend to. For instance, we know of a MIC in Ontario who lends strictly to farmers, and because they really like the farming business, they really understand it, and so they can serve that market really in a niche way. We focus on real estate investors flipping houses, buying, fixing up, and reselling and renovating those homes. So that's an area of focus that we do that we think is quite unique. A lot of publicly traded MICs tend to be, I think, more the larger development kind of MICs, like land development and that sort of thing. There's one rule that there's really only one rule that a MIC, maybe two, I'll say, that are written into the Income Tax Act that governs how a MIC invests. And one of the rules is at least 50% of all the money it invests in mortgages must be invested in residential mortgages. So you can't have a purely commercial pool of mortgages. But land development, where the point is for homes and residential development, I think that qualifies as residential in most MICs' opinions. So I think there's lots of MICs that go that way because they can raise a great deal of money, and obviously land development takes a lot of money as well to perform.
Okay.
And then you'd get MICs that have other niches like debt consolidation or second mortgage lending, those sorts of niches across the country.
Lots of different niches. Now, I want to come back to that, but before I do that, I just have to say what I was supposed to say at the beginning, which is that we are on July 17th doing one of our focus workshops on, this one is on just understanding the creative side of real estate investing. It's an introduction to creative real estate investing, understanding the 5 or so major strategies. And so that's on July 17th. So for anybody who is listening today, my sweetie pie and producer Donna is going to be giving away one free registration to our July 17th event. So if you're listening today, you can make sure Donna knows you're here by, saying something in the chat. You can send her an email. She will, in the end, know who has been online, and she'll do a draw, and she'll get in touch with you. And if you've won, that'll be great. So it's my bit of promo that I forgot to say. Donna, how did I do?
Thank you.
Thank you, says Donna. Thank you. So with the wide range of MICs in both, the market they're aimed at, and I guess in the size now, you're up to 100 and how many millions of dollars under administration?
174, I think, right now.
174 million. And so I'm guessing there are smaller MICs, and are there much bigger than this, or are you starting to get up there in terms of size?
There's a wide range for sure. I don't know what the largest MIC in Canada might be, but I would believe that they're probably $500 million or more.
Yeah.
And for sure, we know MICs that are $3 million or even smaller.
Yeah.
What was really interesting, a couple of years ago, the Securities Commission decided to define a mortgage as a security. And when they did that, they really required us to have more professional fundraising activities. I guess from the seminar you did last week, some people might know a little bit about that. So we were able to raise money kind of through an exemption. But that came to an end under the Securities Commission. And so what we found actually was that the small MICs decided to give up, a lot of them anyway, and in favor of the larger MIC. So there was some consolidation that happened about a decade ago or a little bit less in the MIC space. So we tend to find a lot less smaller MICs just because it takes a lot of work and a lot of accreditations to get going and get started. Whereas a dozen years ago, it was quite easy to found a company that was a MIC and start lending the next day if you found the capital. So this isn't all bad. I think it's kind of professionalized our industry. It's made it a little stronger. It's made it a little bit more reliable. We've gotten a little bit more professionalized in terms of our association. We get followed, for instance, a lot by CMHC. CMHC doesn't regulate us, but they follow us really closely. They ask for our statistics, who we're lending to, how much we're lending, and they want to know if we're becoming a bigger size as an industry in order to see what's happening in the housing market. People may or may not know that CMHC is responsible for two really things: housing policy and helping banks invest in home mortgages, but also in keeping track of the housing and finance industry. So that's the capacity that they track us in.
And I have to say I didn't know that, and so it makes sense that every once in a while you'll see an article that saying, well, across Canada, this is how people are investing. Here's how they're getting their mortgages. X percentage go to the big banks, and then there's a category for MICs. These many people borrowing privately through MICs. So I guess that must be CMHC stats that are driving that kind of information.
Exactly.
Must be. All right. Well, with that kind of background, I guess one more thing. Last week on last Monday, one of our students, one of our members, has actually started a MIC and was just telling people how much effort and time and money and how much you spend on professional fees in order to set up a MIC. So, folks, it's certainly not for the faint of heart. You can do it if you have capital and you want to go through the hoops and pay the lawyers and the accountants of various kinds that you need, and jump through any of those Securities Commission's hoops. Certainly can be done, but you will spend a fair passel of money doing that, just so you know. Now, Dale, let's move on to how Calvert participates. So your niche, as you said, I guess it's mostly you're lending to investors who want to do fix and flips. And I think fix and flip is, we often say, one of those worldwide things that you can say. You could walk into a bar in Dublin or Buenos Aires or Vladivostok, and somebody can understand you and say, what do you do? And you say, I do fix and flip. I'm a fix and flipper. Everybody would go, yeah. My friend, my brother does that. So it's certainly a worldwide strategy. People understand it worldwide. And is that really, did you say most of your lending is in the fix and flip niche?
I would say a little bit more than half of our business is on fix and flips. We also, we really love that business. I mean, we really love working with real estate investors. They teach us a lot, and it's an exciting business for us because we get to know our clients better, because they tend to do more than one project, and so we get to see them succeed through the years of owning 5 at a time, or 3 at a time, or 2 at a time, and doing more and more. So over the years, that's really what attracted me to staying at Calvert when I first started, is developing these long-term relationships with people doing this sort of work. So that's one of our main niches. We specialize in a number of others. One quite small one is construction. It's quite small right now because maybe a little bit because of the market, although it's picking up steam, but it's also a very intensive way to lend money. A lot of expertise is needed to make sure that you cover your risk in that. But that I personally really enjoy doing construction lending. Believe it or not, a really big category for us would be lending debt consolidation, equity takeout, not just for debt consolidation, but people maybe who are business for self who can't qualify at the bank, but would qualify here because they can afford the debt in a second mortgage, for instance. We do a lot of that kind of lending as well.
Okay. Well, let's get into some of the nuts and bolts. So this is a creative real estate group. Folks in here, do agreements for sale and rent to own, and fix and flip is always of interest. Fix and flip is kind of, it's kind of like, it's mythical. It's mythical. Everybody knows someone, or if they don't know someone, they believe that there is a property out there where for some reason you're able to acquire the property way under value, and then by fixing it, you add value back in, and your after repaired value is going to be way more than what it cost you to buy it and what it cost you to renovate it. And there's incredible profits to be made in fix and flip, is I think the myth part of it. And so we know, because we teach courses in this, and we know from our students that there are absolutely unbelievable deals out there, deals you cannot, you just can't make up why somebody can find a property so undervalued, but it happens a lot more than people think. It's certainly not every deal or every second deal or even every 10th deal, but there are a lot of deals out there where you can buy a property way undervalued, and that's often very exciting for our students, because we teach them to not beat people up, and if there's some other thing for a seller to do other than sell so far undervalued, we tell people to point it out to a seller. And when a seller says, yeah, I know all that stuff, but you know what? I'm selling to you. I like you. Then you have the benefit of good karma and a great deal at the same time, and that's the best deal, I think.
I agree.
So when you in the niche section of fix and flip, do you have some kind of general underwriting criteria, that just the broad brushstrokes that our folks would like to hear, that if you're coming to Calvert with a fix and flip, before we get into some particulars, what are the broad brushstrokes that you want to see in a fix and flip situation?
It's pretty simple. It boils down, number one, to profitability. We don't want to help people get into a mistake or a problem or something that's going to cause them heartache. Where if you're in this business for business purposes to make a profit, we really want to support you to get the right deal. So profitability margin is really the first underwriting criteria. The details after that are that we lend up to 80% of the after repaired value, not exceeding the purchase price. People put a minimum of $10,000 down, and then they take care of the renovations and the monthly interest-only payments until they've sold it. But the big thing to emphasize for sure is profitability. We really want to help people do good business and enjoy it. And one way that we do that, and one way that we find maybe mistakes occur, is just in valuing the property as if it's complete. That's something it takes a certain amount of skill and access to the market data to find whether you've got a profitable deal. And so we do our own valuation work, which is pretty unique among lenders as well as mortgage investment corporations. Not a lot will have in-house valuation services, but we really like that kind of that piece of the business, because we can analyze quickly and return that information to the real estate investor and sometimes that's what investors need in order to get a good deal too, is to be able to close quick or get an answer to the seller quickly that, yep, I've got no conditions now, my financing is secured and I'm ready to proceed.
But that is big, because often fix and flip deals where you're just acquiring the property, part of success in just nailing down a property is to be able to move quickly. So when you say you can move quickly, what does that mean? Again, broad brushstrokes. I realize every situation is different depending on what people show up with, but what does quickly mean in your world, roughly speaking?
Well, it's not uncommon that we'll look at and approve a deal within the same business day. So a couple business hours to 8 business hours, we certainly have performed on that sort of timeline. Not every deal requires that, but when it does, we can certainly perform that quickly. And obviously, it really depends on the investor having all the data they need to be able to give us so that we can digest that information quickly. And mostly it's about the plan. What would the property be worth if I did these renovations to it, and give us the vision of what that end result of it renovation looks like, and then we can perform quickly and look at the value. Where there's more of a difficult business plan, or we don't really know what that end renovation will look like, we can still work with the investor too. But it just may take a little bit more time, because we got to suss out a little bit what that renovation ought to look like.
Yeah. Well, a lot of our folks I know are newer in the creative investing space. They're trying to find their way. They're wondering what strategy might fit for them. So I'm expecting that some of our folks, not maybe that haven't taken one of our courses but only belong to our group, will show up on your doorstep and say, Dale, I've got my eye on a piece of property here. I'm pretty sure I can get it for X dollars under value, and I've got some idea I could add this kind of renovation work to it, and it might be worth this much afterwards. And all they've got is basically what I'm doing. They don't have any. They haven't done one of these before. So they have no experience in doing it, and they're just giving you kind of the excited version of why they think you're going to make a whole bunch of dough. And I know you'll be very good at saying to them, I think this has some possibilities, but before we can help you, we need, and what specifically are you going to need from folks in order to make your assessment? And this is not a fast one. Obviously, we're not doing this one in 8 hours when somebody's come in.
I like to say, if you've got your first one with us, give us a couple days if you've got the time, because we'll learn about each other and we'll learn about our process, and the next one can get faster. We've done one of the flippers that Calvert's dealt with. He retired recently, but he worked with us for 20 years. So over a 20-year period, you get to know how quickly you can do a deal together. But yes, when you're new with us, the first one may take a little bit of time. And we actually like to think about the whole business plan when we think about a flip. So the things that we would list out on our fingers, like you just did, would be, tell us a little bit about how you expect to renovate the property. What expertise do you have to do that? Are you hiring it out? What expertise do you have in making sure that your budget of renovations is reasonable? Have you brought in an expert to help you if you're not one yourself? Or if you do this on the side for other people, but you're doing it for yourself now and you have that expertise, great. We ask things like, how did you come up with a vision of what the property will look like at the end of the day? And, have you got good advice from a realtor who knows the market really well, or that community really well? Or have you studied it yourself directly? And then most people are quite easy with this one, but what's their structure for the end game? What's the marketing? How are they going to sell the property? Most answer is just use a realtor, which a trusted advisor to help them price it and get it back in the market and sold quickly. Sometimes it's for sale by owner. We'll walk them through that business plan if that's what their intention is. But really, at the end of the day, we're trying to really support an investor that has a holistic business plan. And if there's some weaknesses in their business plan, maybe we can offer some advice or some tips or tricks to get them thinking a little bit bigger, thinking a little bit more holistically, and hopefully more successfully as well. Because we don't want people to try a flip out and then not succeed. We'd really like them to succeed selfishly, so we can keep doing business with them in the future, and I'm sure for them too, so they can make money and be happy and move on to the next one as well.
Well, you know, and just I mean, what you want is a whole stable full of people like your investor who just retired after 20 years of doing fix and flips. I mean, if he's been your client and customer for 20 years, obviously that has worked well for him and his fix and flip model. So that's what you want, is a whole bunch of people like that.
Yeah, exactly.
Now, there's a bunch of questions that I want to, before we often wait till just before the end, and then there's not enough time to answer questions. But I just want to ask you one more thing before we move on to a whole whack of questions. So that is, why? So I don't know if people understand how Calvert makes their money, but you know, you will lend money to people and you will charge them an interest rate and perhaps a fee. And I mean, you've got to make some money as well. And necessarily, I think you charge more than a bank would charge for a loan. So why do people come and see Calvert and not go to their favorite bank that they've been dealing with forever, where they know them and they know their whole story? Then they go to the bank and pay less interest. And tell me about that part.
Well, it's an excellent question, and I think I should answer it for all MICs, really, and as well as a little bit for me specifically. But really, because MICs don't have the same regulations as the banks do in terms of how they lend their money, we can be much more flexible and creative, and we can, we don't have to strictly observe debt service ratios, for instance, that the Office of Superintendent of Financial Institutions requires. So I can lend to somebody who maybe can't prove their income, their business for self. And so I've got that kind of flexibility, which the banks don't have. So for most MICs, that's really the blunt answer, which is that they can get money on a little bit easier terms. Not terms, but underwriting criteria. Yeah. Some people also access MIC money, even though they would finance at the bank, but the bank might be taking too much time to approve their deal. And that's not common. The banks are pretty quick these days, but every once in a while we do run along across somebody who is completely bank eligible, but they need the money literally tomorrow. And we can actually provide that service. That's not often done either, but it's certainly within the realm of possibilities, which the banks, it would absolutely not be a possibility whatsoever. So that underwriting criteria and that speed of service are two main reasons.
Major things.
Yep.
Well, just one last thing before we get on to some questions. In terms of speed of service, that is the single biggest trouble that I have in my real estate business as a lawyer in my real estate practice, is waiting for lenders to approve mortgages. Last week, or just a webinar or two ago, we were talking about this, and we were waiting for some Royal Bank instructions, and we finally spoke to the Royal Bank in-house broker, who said, listen, normally Royal Bank gets 2,000 to 2,500 applications per day across the country, across the whole country. But right now we're getting 8,000 applications per day. So, it's not going to be anytime soon that you're going to get your stuff. We heard last week from Keaton Kirkwood that there's a credit union he deals with where if you're doing an insured loan, it's 5 to 6 business days. If you're doing a conventional loan, it's 8 weeks. And if you're just looking to do a refinance, it's 12 weeks to get approval. So other lenders are, because of the pandemic busyness, having a lot of difficulty. And if Calvert is still able to provide the kind of service that you guys are famous for, then that's really good to be able to manage it in the midst of you guys also being very busy. So folks, that's just something to really tuck away there, that Calvert still can do things quickly, and other lenders are really not. It's messing up a lot of deals. All right, some questions. Wayne, I'm going to let you pop up the questions that you think we should do. Stick them in the middle there somewhere. And Mr. Cabral says, George, would you open a MIC today? Are you asking Dale whether he'd start a MIC today? I think that's what you're asking.
Yeah, and I certainly would, because I believe in the business plan. I believe in the service to the clients too, and I think there's a niche and a need for it out of there in the marketplace. And we talked a little bit about how hard it is maybe to get started as a MIC because of regulations and securities qualifications that you've got to jump through. So it becomes harder to do, but certainly not impossible. There's expertise in the market that you can go and hire out if you don't have it yourself, and it's not impossible. The other way to start a MIC, by the way, too, is, and there's several mortgage investment corporations that don't have just one MIC. At Calvert, we're just one fund. But a lot of our competitors might have several funds under administration under one umbrella. And so a person starting a MIC doesn't have to really start it totally on their own. They could maybe come under the umbrella of somebody else. So there's other ways of cracking the solution other than just doing all the brute work yourself.
All right. Ron says, are there MICs for down payments for a lender mortgages? Oh, interesting. A MIC is the entity that provides a 20% down payment, goes untitled, and gets a traditional investor mortgage for the 80%. Ooh, good one, Dale. What do you think?
Well, that's an interesting question. I guess right now it's not allowed, which is the short, quick answer. But even if it was allowed, probably a lender wouldn't go to 100% loan to value. And so that's probably the really big difference, is the investor would be taking on too much risk. The MIC would be taking on too much risk. So I don't think it was ever done, even when it was allowed. Although the reason why it's not allowed is interesting. OSFI, and not that long ago, suggested that it shouldn't be allowed that mortgage companies bundle their mortgages. So we'd have, let's say, an A lender that would partner up with a MIC and say, listen, we'll lend up to 65% loan to value. Why don't you guys lend up to an additional 20 and we'll go on title together? And that was being done for a while, and actually probably higher numbers than that. But up to my knowledge, the highest it went to was 92% loan to value with a first and a second combination. And OSFI put an end to it because they believed that it was an inadvertent way for the banks to skirt the rules of OSFI. And so it didn't fit under the underwriting guidelines in their opinion. So they put a squash on that.
Just another example of how regulation can stop innovation.
Yeah.
Okay.
And actually how they can regulate MICs without regulating MICs. They basically told the financial institutions, you can't do this. But so it inadvertently did regulate MICs, even though it wasn't directly.
Here's a great question. How would you do diligence on a MIC? There's lots of MICs around. How do you know whether they're good at what they do? How do you do some diligence?
Yeah, I've invested in other MICs as well, not just my own, because I really believe in the facility. Here's the key questions I would ask. I mean, I would definitely look at the financial statements and read their reports. But what I want to know if I'm investing in a MIC is how much of the MIC the managers have an interest in. Are you a buyer of this product as well? You're managing it, but do you believe in the risk? And I really want a management team who is aligned in the interest of the investors to make the best return and make the smartest decisions to not lose that money and protect that return. I would also look at the portfolio makeup of that mortgage portfolio. So, ask some questions about where their concentration is and where they lend in, and how they adjust with the times when economic conditions change. Do they watch them? Do they keep abreast of what's happening in the market so that you can see that they're being reactive and also proactive in their approach? I want a management team that understands that at a pretty high level, pretty responsive to what's happening in the market. Those would be some of my quick pieces of advice.
Those are some good ones. Something else, when you talk about the portfolio makeup, it's also the portfolio location is important. Some MICs got themselves into trouble in Alberta when we have a soft market. If when they're not in the niche that Calvert is in, and they're in a maybe a little bit of a more traditional lending niche, even though it's in the mixed space, they got themselves into some trouble because they were too concentrated in Alberta. And something else, this is a question I guess I have for you. I believe that a MIC decides whether it can enter a redemption request. So if I've got $100,000 in Calvert and I decide I need it, I'm sure you have internal rules about what it will take for me to get my $100,000. And if life isn't going well for the MIC because they haven't been underwriting properly, I think you can also say to me, sorry, Barry, there's too many requests for redemptions, and so we're only doing this amount and we're parceling it out between everybody, and you can have 1% of your request. And that amounts to not very much, Barry, but that's so is that something people should be aware of? Is that a question you can ask a MIC? Have you ever not redeemed?
Yeah. An investor should ask a MIC what liquidity they can provide an investor should they ask for it. And it's understandable. Some MICs can't. They certainly can't promise that you can have 100% of your investment back at any time, because if every investor said that, they would quite literally have a run on the bank, and they'd be out of business. For us, we provide liquidity on a 10% per year basis, and pari passu with everybody else, so that if we get too many requests, we can equitably deal with as many people as ask for it as possible. And public MICs who are on the public stock exchange, obviously they've got great liquidity because it's the subject to the public market, somebody else buying the share, and the company not managing who else might buy that share. But it's an excellent, sophisticated question an investor should ask, and really private equity, so non-public stock exchange kind of market like that most MICs are, they can't provide perfect liquidity like the stock market can.
Okay, that's so that answers the diligence side of things. What are the investor requirements? I have heard of 100% for some acquisitions. What's the real story? I'm not sure I understand. Loan to value, is that what it? Yeah. What are the loan to value requirements I have heard? 100% for some acquisitions. What's the real story? Not quite sure I understand that.
Yeah, and maybe the question could be going one of two different ways. The loan to value requirements is set by the MIC. And certainly we know of some have gone as high as 92%, as I mentioned earlier. Many MICs might even be as low as 65%. So it can range anywhere in there. And 100% acquisitions. I'm not really sure where to go with that one.
Well, maybe you could expand on that.
100% loan to value.
100% loan to value. Facebook user, glad to have Calvert in Ontario. It's mostly short-term funding that you specialize in. That's the question.
Yeah, great question. In Ontario, we've just decided to focus on the short term and real estate investors, so flips in Ontario. We also do, I did mention it, it's a relatively small piece of our business, but we do a lot of bridge loans. So people that maybe have a property for sale and a property that are purchased at the same time, and they need bridge money in between. We also do that service. So we do that in Ontario as well.
And just to confirm, Dale, you're lending now in Alberta. You've now moved into Ontario, but not in any other province and not in the US. Is that? correct?
That's correct. And actually, MICs under the Income Tax Act can't lend in outside of Canada. They were an animal of trying to produce mortgage money in Canada only.
Okay.
We would love to take our product to other places in Canada, though we think that there's good need for the fix and flip product particularly.
Yes. Yeah, like everybody does it, right? Everybody wants to do fix and flip. So what returns can I get investing with Calvert?
Well, I knew this question might come up. We have produced returns, and we target them for between 8 and 10% annually. And that's what we really strive for, and have had a really good track record lately of doing that as well. There's one major thing that we'd be remiss in not talking about in terms of returns that is the real huge benefit of mortgage investment corporations. When they were started under the Income Tax Act, they were automatically RRSP and other registered account eligible, so TFSAs, RESPs even. And that's the real beauty of a MIC, because all of the income that a MIC makes throughout the year is not taxed at source. So our company doesn't pay income taxes. We have to send all of the income, interest income, to our shareholders. They put that in their RRSP, and they're not taxed as well at that year. If they own the shares personally outside of a registered account, then they obviously do pay tax. But because of that non-taxable entity up front, it's an efficient investment vehicle. And that was really much more interesting and important in the late 70s or early 80s when the government created that MIC status. It's less unique now for sure, but it's certainly very tax efficient. So that's one reason why we've got a lot of capital that likes to invest in MICs. And generally for the market, I would say you can find MICs that will range in returns. I think probably the good ones on the low end might be 5%. And I certainly know of some that have been able to achieve 12% periodically as well.
So that's something I want to dive into a little bit more. So if you at Calvert are aiming at 8 to 10% and achieving that recently, that's a fabulous return in an investment climate where, $1 trillion of the $3 trillion worth of bonds that are being sold are negative interest rate bonds. So you got to pay somebody to hold your money for you, let alone get something back. So if an investor can invest in Calvert and at least currently get 8 to 10%, then of course to make money, you have to be lending at a higher percentage than that. And so let's meet square on the issue of people who go, Calvert, other mortgage investment corporations, they charge so much interest, it's not fair. I would never pay, fill in a number, percentage point to borrow money from guys, bloodsuckers. Who do they think they are? Okay. I guess all right. I guess I've beaten that up enough. And so we all know that there's a great answer for that. So what I want you to tell me why it makes sense for people to invest with Calvert and pay the fees that you guys charge. Why does it make sense for people to do that?
Yeah, to get the mortgage from Calvert, in other words.
Yeah, to get the mortgage.
Yeah. To me, it really boils down to service, and not all MICs take this maybe as seriously as we do, but we really don't want to do deals that don't serve the clients. And so, like when I talked about flips, wanting to make sure somebody's profitable, we don't want to help people into a mistake. Some lenders might, to be really blunt. I mean, if they're safe, why wouldn't they lend the money? But we really want to partner in the success of the client. And it's really clear when it comes to real estate investors, if they're profitable, then they're successful, because profit is their goal, at least their largest goal, that we can transparently see and then evaluate as well. And even as to the other systems of financing that we do, home ownership and so forth, when we are helping people with debt consolidation loans, yes, a 12% second mortgage might sound like a lot of money. But if we're paying out 18% credit card debt and we're making those payments more affordable, this is serious help. It is really debt relieving. If they can afford that, even better. And by the way, if they can't afford that, our counseling would be, can we help you in the short term get your payments under control, and can we maybe counsel you that you can get your debts under control, reduce your cost of living, and save more going forward. So for sure, we take a person's financial success really seriously in every mortgage that we do. And we don't just charge interest rates to make the yield. Of course, our investors love the yield, and I do too, but it's got to make sense for the homeowner for sure.
Okay, folks, I want you to just play this over in your brain. What Dale just said. What the position they come from is helping. It's not a hard-nosed. Of course, they're hard-nosed about their business because they have to be, but they come to it from a position of helping. They want everyone they deal with to be successful. If everyone they deal with is successful, then it's a win-win all around. It's not just looking at a situation where you are covered. And as Dale said, there are lenders out there who will look at a borrower's equity position and give them a 50% loan to value loan, and say to themselves, well, this one's going sideways. We'll be foreclosing here, and they're covered. There's such a big chunk of equity that the homeowner has in the property that the lender will never lose, and so they lend in the face of knowing that it's going to be a failure for the borrower. That's not what Dale and his gang do, and that's not what we teach in our focus workshops. We play for win-win, and we play for helping people. And if you always have the person across the table from you's best interest at heart, then you almost cannot do anything but succeed in whichever business enterprise you're in. And that applies when you're buying your property, and it applies when Dale is lending. It's the same concept. If you play for win-win, and you really truly have the interest of your client or your customer or your partner at heart, then it's, as I said before, it's great karma, and it's the right way to do business. It's the successful way to do business. So I just want to get out there. That's how Dale and his folks look at things, and that's the way we do too. What you're doing has to work in their estimation, and if they don't think it's going to work and you're hurting yourself, they'll counsel you not to do it. They're not just going to do it because they're going to make some money. Is that right, Dale?
That's absolutely right. And we really believe that's the best kind of underwriting that we want to do anyway, which is, and underwriting is just a fancy word of decisioning, but how we write mortgages is for the success of the client, because, if they're successful, we're successful.
Yes. Just reading a couple of Facebook comments. If it allows an investor to get into a deal and make a profit, I'm reading a comment, not a question, then with higher rates, doesn't matter. Everybody wins. Success of the client is the way business should work. The right thing to do. Win-win. All right. Tim says, is Calvert available for funding multifamily commercial?
Yes, absolutely. Yep. We, to be honest, we don't do a lot of this business type, and most of it is because it's got to make sense for the investor. Where we really add value for a multifamily building, financing is less likely to be a long-term loan. Sometimes it is long-term loans in second position to a first lender. Other times, an investor might buy a multifamily building in order to fix it up and refinance in for the long term. And commercial, we get tapped out just because of size of some commercial. So we do some small commercial lending, like a bay in a strip mall, or a bay in a condo bay, that sort of thing. So Not a lot of commercial, although there's some mix that do a lot more of it than others. But like I mentioned earlier, they can't focus on that 100% just because of the way the MIC rules are. Although I should say there are alternative lenders who are similar to MICs, but not technically a MIC, and they can concentrate 100% on commercial. So there are certainly non-institutional private lenders that or alternative lenders that lend to the commercial market.
All right. All right, let's see if we got any more questions here. Sean Impey, Mortgage Investment Corporation.
Oh yeah, someone was asking what a MIC stands for. And yeah, Mortgage Investment Corporation, you're right.
All right, there's Katrina asking. And here's the question. So you guys lend all over the country, right?
No.
Oh.
Just in Alberta and Ontario.
Alberta and Ontario.
I'd love to help people from across the country. I think there's a need for it, but there are MICs in lots of different jurisdictions. Probably dozens of MICs in every province in the country, although I can't speak for the territories. I don't know too many up there, but there's lots across the country. And actually, if you just Google the term MIC or Mortgage Investment Corporation and then the province name, I'm sure lots will pop up for you.
Yeah, there's some material that you can find, some CMHC published material where they commissioned studies on various MICs and, listed them as to size and portfolio makeup and return. There's lots of great information available without too much of a deep dive. Just, Google Mortgage Investment Corporation and you'll get a ton of information. You'll be sorry you asked. Do investors in a MIC get any soft cost write-offs?
No, they don't. But they have to get 100% of all the interest income that the MIC earned throughout the year. So they get 100% of that income. A MIC can't hold even $1 back. They have to send it out to investors. Otherwise, they disqualify themselves as a MIC, which is a big penalty because it would make that investment in, let's say, an RRSP ineligible. So MICs make sure that they don't do that. So the only benefit you get is the interest income, which should be enough. But back to the earlier question about due diligence on a MIC, do keep a good eye on their expenses and make sure that they're reasonable for the size of MIC that they have, and make sure that they're managing their costs effectively.
Yeah,
that's so important. Diligence is always important. Well, folks,
there was a question about financial statements.
Question about financial statements, but I have something that says that's it, Donna, right there.
Okay, that's it.
That's it. There's always more questions than we can get to, but we do follow-ups, Dale, and one of these days we'll do a follow-up on the securities stuff that we did last week. We didn't quite get to what the Securities Commission looks like when you are out trying to attract cash. What are the things that will have them coming down on you like a ton of bricks? So I expect that this will provoke more questions from our group. They're very active. They're very interested. So as always, it's a ton of fun getting together with you. We always have a lot of fun when you do this. So thanks for coming on and giving us some of your very valuable time. I think this was very well received. So it's much appreciated, and we all thank you.
Oh, well, thank you. I appreciate you having me here. It's great to talk with you, and thanks for all the great questions.
All right, everybody, we're signing off for tonight, and we'll see you next week. Thanks, everyone.